Okay, everybody, welcome to the special session. We'll start. In the future, though, when you go to log in or connect into the Citrix software, the desktop sharing software, you need to use the same email consistently. If you change the emails, it's not going to recognize you when it asks you for the email. So please, in the future, just use your same email, and then we won't have difficulties trying to get everybody in here and delays and so on and so forth. All right, can everybody hear me okay? We'll get going here. Let me know with a Y or a yes that the sound is all right. Okay, sounds like it's okay. All right, so let's get going. We've got a lot to cover today. We may not be able to get through it all. I'll do my best, but Walter says you use 2 email addresses. That's fine. You can have 2 email addresses, Walter. You can have 1,000 of them, but use the same one that you use the first time for here. If you change them each time, the system doesn't recognize you, and then you're out of luck, and then it causes delay and so on and so forth. So I don't care how many email addresses you have. I've got multiple ones too. Just use the same one here. All right, so for today, I want to do a little bit of integrating the trend lines and the waves here, and talking more about context. And we'll just use the past week or so in the S&Ps. It's a good example. It's always a good example. This is what I always do in the class, is I take the past week in the S&Ps, and I just look at how we can integrate the waves and the trend lines and see what we can see. And we can always see an awful lot. There's also one person sent in their assignment from Wednesday. They're quick in doing this, which is a good thing to do and a good sign for that particular class member. So I want to review that a little bit. It's a very good chart. Then we're going to get into reading price bars and volume, and I want to show you how we do that, and what we use and how we do it. And then from there we will do a little exercise on reading the strength off of a bottom that reverses from down to up. And then from there we're going to talk about I guess there's 7 major indications of strength that I look at. And we may not get through all of them. I'll do my best. But I also don't want to just zip through them either. I want to make sure that everybody understands them. And then we'll talk a little bit at the end about integrating these two, and that'll be the assignment for this session. And I want to emphasize something up front, and I'll emphasize it again later, and I'll emphasize it again next week and thereafter as well. Although we're going to talk about signs of strength, indications of strength, they're not signals. So do not treat these as signals. Okay? Let me just restate that to emphasize. Do not treat these as signals. Okay? Always, 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 background, structure, and a story that you can create will always, always, always trump any one of these. And for those of you who may not have English as a first language, trump means that the background and structure and story always takes precedence over these indications of strength. Okay? So don't turn this into a candlestick game, because it's not about candlestick. It's, in other words, reading the hard edge of the chart, the right edge of the chart, and just looking at a couple of price bars and saying, oh, it's a stopping volume, or oh, it's a climax. Don't do that to yourself. That will only get you in trouble. Okay? But when we combine those, when we combine the indications of strength with the structure of the market, and we can tell a story about it, then we've got something. All right, everybody with me okay here with that? You should sort of staple that onto your forehead so you don't lose it, or put it onto your computer monitor so you don't forget that. All right, here is the past week in the S&Ps, and it is it's a 27,000 tick chart. In other words, there's 27,000 price changes in each one of the bars. Tick charts are often a very useful tool. We'll talk more about them. I don't want to go into much detail on them tonight, but they're a very useful tool. I use them all the time in trading the S&Ps. I use a 3, or I'm now starting to go to more like a 3600 or a 4000 tick chart for the smallest time frame, and a 9000 and a 27,000. The 27,000 captures the market structure pretty well. I even go higher than that, but here's a 27,000 tick chart. So let's take a look and see what happens here. We're going to start right at the right edge of the chart, right over here. And look, what can we see here? Immediately, we can frame out. Let me choose a good pen color here. Maybe, how about black? We don't ever use that. We can frame out a small trading range that exists here, and we can see that the market is moving in that trading range a little bit. It tries to jump over the top of it, and it fails to follow through. We call this an up thrust. We'll talk about that next week. And the market drops down. And what do we notice immediately? What do we notice immediately in terms of the wave structure of the market? Anybody? We have longer down wave, right? And we've broken through the trading range here. We've broken through this area, and now we have a lot larger down wave. So what is our position? What do we want our position to be? Do we want to go long, or we want to go down, or we want to go short? We want to look for short opportunities, right? Exactly. And a nice short opportunity presents itself here. Not even here is not so bad, but now we can lean against structure and say, well, this is a test here and it fails. And we can go down, we can take that market down and look at what it does. A beautiful move down. So this was that big downdraft that we had in the very beginning of the month and of November. And you don't have to be right there at the top. You can see that it's coming because of the wave structure. So it's pretty nice that way. So we can draw in the waves here. We can see that the down waves got larger, but also we draw in a trend channel, and clearly this market gets oversold down here, right? And it's a huge overselling. And this market moved from a high of about to 1280 down to 1210. That's 70 points over a day or so. That's a lot of points. It's going to be oversold in the S&Ps. A 30-point day is a big day, and this is twice that, more than twice that. So then we start to go into a trading range down here in the bottom, right? And we can highlight that, and we can draw in a horizontal resistance line here off of this high. And notice that if we extend... Yeah, sweetheart, can you hear me? Ning? Okay, hang on everybody for a second. I do this every time, sweetheart. Ning! Gotta turn your radio get out of the...
Yeah, I know. I'm going to get out.
You're typing and everybody can hear it. Okay, so we're back. We should hear no more typing. That's Helen in the background there. She didn't know she was still on. Okay, so we extend our supply line down, and notice we have confluence occur here, right? And we can take a short trade there. Even though we're oversold, it's likely that we want to that market wants to go back down and retest this low. And it doesn't make it all the way down there, but we can see in the structure that it tests to this point here instead. And we can, see how the market moves within this level of structure. It's pretty straightforward. We then break up above the trend channel here. If we extended this down a little bit, you get to see what I mean. We break up above it. Now the up waves are higher, but we fail to go up. We fail to follow through. This is a 27,000 tick chart, so this is probably a 25-point move in here, give or take, and that's a nice trade if it's occurring during when you're out there trading. Okay. So we can see then that the market comes down again, breaks down through this support, comes onto this diagonal trend line that we can draw here, and also we could draw it earlier, and we have another piece of confluence here, or another bit of confluence here that I didn't put in, but clearly that's there. It drops down to this support level, then rallies through this resistance line here. That's strong. That's very strong. And not surprisingly, the market rallies up and breaks on through. Right now we've got up waves higher than substantially larger than a down wave. So now we're going to be looking for long opportunities. All right. We come back down to support here. Here we had resistance where the market was, it had resistance a couple of times. Now it comes down to support and it pops back up above that. Now we want to look to go long. And where does it go to? It goes to the top of the resistance level again. And it has trouble up there. Okay? And it drops back down again. And notice now we have an access line forming. We had resistance here along this line, then there's some support, it rallies up, comes back down, support again, rallies up, and support again, rallies up, fails, and then comes back down for another time to be supported at that same level. We can extend it out even further. You can see that it acts as support over here and kind of as resistance in here. This market rotated around this level here of 1238, give or take, for quite some time, almost the entire week, right? All right, we rally up, we push up above the level of resistance here, as represented by this line. We come back in, we test it here, right in here. It's not confluence because we wouldn't know that this demand line exists until after this market has started to rally up. But then we can draw that demand line in and draw a parallel supply line, and look, we can see that supply is coming in earlier, or demand is tiring out up here and failing to get up to the top of the supply line, and then it drops down through the resistance level again, and so this resistance is still active, and we drop pretty good down here, right? We can look for short opportunities at that point. You can see that as we lay out the structure here, the market starts to trade in a small tight trading range in here, and we can extend our access line out a little bit and be aware that that's occurring down here. Not a surprise that this market drops dramatically and comes right down to the access line, right? Just so you've got that clear. We talked about this the first week. These are very important. We see them all the time, and a lot of times it'll set up across a week when we have a big trading range like we've had this past week after the market falls down, that an axis line will set up, and that's what it rotates around. It tries to rotate around that. And you can see that that's been fairly effective in here. We drop down again, but we don't come all the way down to the demand line, and we can draw a reverse use of trend line in here. And the market then rallies up in the last bit here. Rallies up, breaks down, breaks the supply line here, and breaks that. And we go into a little bit of a trading range, but notice that the supports are lifting, and we can draw our trend line here, a demand line in here, right? And we have a resistance line, and now we've broken through, and once again, up waves are larger than down waves. So what are we going to look for? I mean, just looking at this market here, if you're trading this, what are you going to be looking to do on Monday? What would you be looking to do on Monday if this is, and this goes up until Friday afternoon? If you're trading this market, are you going to be looking for a long opportunity or a short opportunity? Long, right? Yeah, that's right. You're going to look for a long opportunity. If the market comes back down into this zone here, right in here, whatever this level is, this would be a great spot to try to find a long trade. Okay, it may not. You know, we don't know what it's going to do. It may just rally up from here, but it may come back down into this area, and that would be a spot that you could look to go long on. All right, any questions on that? You can see, though, I hope you can see that laying the structure out like this, just using the waves and using horizontal, for the most part this week it was horizontal trend lines. Sometimes it's more diagonal trend lines, but whichever it is during the course of a week, you lay these out and you can start to see the things that are occurring here. Does everybody see that? How useful this is? And now what we want to do, and what we're going to start to do, is we're going to look at some bar patterns that occur, and we want to locate those around these structural points for trade entries. Okay? So we'll talk about a bottom reversal, for example. And when we see a bottom reversal at a support level, well, then now we've got something we can lean against. You know, we can try to make a trade against, and that's the whole idea here. All right, one person sent in, and I asked for permission to use this, and he graciously gave us permission to use this. And this is a very nice chart in terms of identifying absorption and in terms of seeing shortening of the thrust and such. Even though we're coming down on a nice parallel here, trend line, we still see, he's got it laid out here, we still see some of that shortening of the thrust occurring down here on each drive down. It starts off, we get a nice drive down, then a pretty good one down here, but then it starts to shorten up as we come down, and he's got that captured very nicely. And this is the Aussie dollar on the Globex market 15-minute chart, and you can see even this is all the overnight data coming in. I like to use tick charts for this kind of a market, but you can see that even with a standard bar chart, on a standard time-based bar chart, you've got that kind of, you can still see these relationships unfold. And so the market comes down here, has a little sideways movement. Notice how in here, we'll talk about this later, notice how in here there's a zone that gets set up where buying comes in, and actually it starts back in here. You can see all of this zone in here where there's initial buying comes in here, we call that preliminary support. Some more comes in, more preliminary support, and then we get a little climactic action here, and additional absorption, or not absorption, excuse me, additional accumulation occurs, and then we start to rally up. But notice that, let me erase this so you can see it clearly. Notice that as we rally up, we get some nice movement up here, nice ease of movement, right? Here, good acceleration. And then we go sideways for a long time on this chart, whatever this is a 15-minute chart. It took us half an hour to get up to this point, and now we've been in here for a couple of hours, right? And it continues on, in fact, into the next day, it looks like. This is a very nice example of absorption, where we see supply here, and we saw a lot of churning over here. Supply came in, and it's not a surprise that we're in this area. They're going sideways and absorbing the residual supply here. Okay. When I say we have residual supply, what do I mean? What I mean is this: that there are sellers here that went short in here, but then as the market started to rise, and each time it rises, and especially here too, people will think, oh, it's, you can see the volume. You can see the volume. When the volume gets large, people will buy. Or when the market starts, it looks like it's breaking out here, right? People are buying on that. There's a lot of buying going on. And how do we know? Well, we know because of the volume. And they're holding on. They bought up here right at the tippy top, and they've been holding on, and they've been suffering through all of this. And now, as the market comes back up into their price area that they bought at, they're thanking their lucky stars that they can get out. And that's what's creating some of this residual supply. Also, there are support and resistance traders, a lot of those, who are going to be shorting against this because it's a known supply level, it's a known resistance level, and they will short against this. And this market is just absorbing that selling. And that's how we can tell, because it's not going down. Each time we've seen, good moves coming down here, and here for the first time it's going sideways instead of down. And that's strength coming into the market. So that's very nice. Then we get more ease of movement going up, and here we come right into the top of this resistance area here, and we see another level of absorption. And then the market continues to move on up. So that's very nice. That's a very nice chart, and very nice examples of absorption and shortening of the thrust. Also notice too, just want you to be clear on this, that we have an uptrend channel here, demand line here, and a supply line. And notice that the absorption kind of goes in, well, you would draw this demand line from this point and this point, and it respects this very nicely up here. And so you know that in advance. But then as it pushes up, it breaks through. Okay? It breaks through here. Now, often we will see this, and then the market will come back down again, and you say, well, it's overbought here, right? But you have to look at the context of the market. You have to look at the structure. We have all of that. We've just come through a down move. We've broken through the downtrend channel. We've had all of this buying going on here. We've had more buying going on here. We don't expect the market to just rally up after all of this buying and then come back on down again. Okay? So when we see this now, we would want to put on, a different kind of trend, a different trend channel in here. All right? So I just want to, can everybody hear me all right? Somebody says the sound is left. Okay, everybody says it's on. Okay, good. All right, so that's a nice chart. All right, any questions about that chart before we move on? What's the zone? Eric asked, what's the zone that is light-colored diagonal lines at about 1040? 1040 is here. the diagonal lines. You mean this here? This would be, he's referring to this here as supply over here. I think that's what his concept is that there's supply here and that this is absorbing that level of supply. Same idea here and back into here. Okay? Yeah, it's just a supply area that he's identifying. All right, good question. All right, so let's all sing from the same song sheet. And that's what this next section is about. It's about reading price bars and about reading volume. And when you break it down, you look at 4 things, and there are basically 3 or 4 elements to each of these categories, okay? We can look at the spread or the range of the bar. We can look at the direction of price movement on that bar. We look at the close in relationship to where the bar is closing in relationship to itself. And then we look at the volume. Let me explain that a little bit more. Spread or range. The range of the bar or the spread of the bar is the difference between the high and the low of the bar. Okay? So if this is our price bar, here's the high and here's the low, and this in here is the spread or the range. Okay? And that's pretty straightforward. So the spread of the range of a price bar is the area between the high and the low of that bar. And it can be a wide bar or a narrow bar or an average bar, just to make things simple, okay? It can be fairly wide, can be narrow, and it can be average. And when we're making comparisons of wide, narrow, and average, we're really looking at the last 3, 4, 5 bars, give or take, okay? And it's something, there's not a magic number of 3 bars or 4 bars or 5 bars. It's a range of those bars. You've got to develop the sensitivity and the judgment in reading the price bars to be able to determine what's wide and what's narrow and what's average. And believe me, after a half an hour of doing this, you'll be able to do it pretty well. Okay? All right, so that's the spread or the range. Now, direction. What do I mean by direction? If we have a price bar and it closes here, okay, and then we have another price bar and it closes here, then the direction of price on this last bar is up because the close is greater than the previous close. Okay? If the close was down here, then we would say it's a down bar. Okay? Or if it closes about the same in the same area, within a tick or two, we would call it a level bar. Okay? So direction is determined by the close in relationship to the most immediate preceding close of the most immediate preceding bar. Okay? So we might have, they might all be coming down here, and we have down, 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 but then we have this bar is closing up above the previous bar. Its direction is up. Okay? Now, closes themselves, we're interested in those. They can be on the high of the bar or near the highs of the bar, right on the high of the bar, around, that's the highs. Can be on the lows of the bar or near the lows or somewhere in the middle. Okay? 3 different ways to think about it. And then volume for that bar can, and this is again, looking at over the last 3, 4, 5 bars, can be heavy volume or average volume or light volume. Okay? Hang on just a second. Okay, sorry about that. That's the well pump going on. All right, so by using this little cheat sheet, so to speak, or this little 4x3 chart, we can describe any price bar and volume. We can have a wide range bar closing on its highs that's down from the previous bar on heavy volume. We can have a narrow range bar closing level with the bar before it, closing in its middle on average volume. We can have a average spread bar that's up, closing on its highs on heavy volume. Okay, we can describe any bar by this nomenclature. All right, any questions on that? Does that seem pretty straightforward to everybody? All right, so let's go through a little hypothetical example. And I'll do the first couple of bars here, and then let's go through the next, and we'll go through all of them. Okay, so bar number 1. We don't really have any information about bar number 1, so we won't really talk about that. But bar number 2, and I'm just going to compare it to bar number 1 for the for averages or for spread and stuff. But we can say that it's an average spread bar. It's an average spread up bar closing on its highs or near its highs on above average or increased volume. Okay? How would you describe bar number 3? Within this nomenclature, how do you describe bar number 3? Walter says it's the same, just closing on the high. Hans says average up bar closing on the high. Okay. Kevin, average spread closing on the high with average volume. Good. Volume is average. Good. Good. So we have an average spread closing up bar closing on the highs, and the volume is average. Okay. If we look at these last couple of bars and just kind of eyeball them and say, well, that's about average volume. Okay. You could also think about it like this. We have an average spread up bar closing on its highs, but the volume is starting to decrease a little bit. Okay. It's average volume, but it's starting to decrease over the previous bar. What about bar number 4? Tell me about that. How do you see this? Bar number 4. It's a level bar. Good. Average spread. Good. Closing in the middle. Good. On high volume. Right? Very good. Very good. Average spread, level bar, closing in the middle on high volume. What does this mean, do you think? If we now start to look at bars 1, 2, 3, and 4, what does this suggest here with this higher volume, level bar, closing in the middle, so on and so forth? What does that suggest? Sellers are coming in, shortening of the thrust on the bars. I'm not sure I see shortening of the thrust here, but we can maybe look at that. There's supply coming into the market. Some selling is coming in. Good, Herbert and Kevin. Exactly. Here we are. I just made this chart up so that we could talk about it, but this is not atypical of anything that we see, and we'll look at a live chart next, or not a live chart, a real chart next. Here we are, we're moving up, right, and doing okay. And we're closing firm all the way up, and then suddenly on bar 4, we are not able to make any more progress to the upside vis-a-vis the close, because now suddenly we have a level close and the volume's increased. Well, only one thing can do that, and that is that there's some selling coming into the market. Now, maybe it's just profit taking, meaning that people who bought lower down are now sitting flush with profits on their accounts, and they want to take some of those profits. It doesn't necessarily mean that the market is going to turn, or maybe it is supply coming into the market, and we will see a market turn. But let's see what all. Let's keep going. Let's keep going here. What about bar number 5? Whoops, bar number 5. How do we describe that? How do you describe bar number 5? Anybody? It's a narrow spread, slightly down bar, right? Closing in the middle, good, on relatively light volume. Good, everybody sees that. Low volume, light volume, less volume, that's good. Notice that if we look at the volume, it's less than all these others, and the average is probably somewhere in this area here, so it's much less than the average, right? Also, the spread is narrowed down quite a bit. It's smaller than any of the ranges that we see on bars 1 through 4. And y'all got this, right? You know, it's closing in the middle, that's pretty straightforward, and it's slightly down, okay? Now, one thing to notice here is that, here's a question, is it testing demand? Is it testing demand? Is it testing demand? I'm not sure, Kevin, I'm not sure exactly what you're asking. Is it testing demand? A test typically looks to see about supply. I mean, I'll often talk about testing the highs, but to see if there's more demand up there. Testing the lows. TI, what's TI mean? TI would be demand line. Is it testing if there is resistance to have more supply enter the market? Trend line. Oh, trend line. Yeah, I wouldn't put a trend line necessarily off of that. That's a little bit. I like to see some movement up and down to be able to make a trend line. All right. In VSA, they often talk about test bars, but testing after the market's been moving up quite a bit like this is probably not the best place to be thinking about that. Here's the way I would look at this market. We've been moving up. As we came up to bar number 3, volume dropped off, suggesting although price closed firm, there was less fuel behind, there was less effort behind that closing. So there may be a lessening of demand, even though price closes firm. By bar 4, potential selling has come in. That we see a level close. We're not moving up higher. We're not making any further progress, and yet large amount of volume comes into this market. On bar 5, this is how I would read this. That we now have a clustering of closes all in the same area, whatever this is, right? That over 3 bars, I don't know if this is 3 months or 3 weeks or 3 5-minute bars, but whatever it is, over 3 successive time periods, we've been unable to move the market higher. The direction of the overall market has been going up. We see a lessening of demand, a potential increase in supply, and then an inability to rally this market any higher than what it is. If I were long, I'd be exiting out of positions or tightening up stops I wouldn't necessarily take a short position here, but I would be cautious of having any open long positions in this. Okay? And obviously we don't have any structure on this market. This is just looking at the price bars kind of naked as they are, but that's how I would look at this. In VSA, they often talk about this little narrow range bar, down bar on very light volume as a test. But you're looking at one bar and saying that, gee, it's a test because it's light volume and it's narrow spread and it's a down bar. Well, that's not in the way that I look at the market. That's not good enough. It's the same kind of candlestick game that you get lulled into, looking at the last bar and making decisions based on one bar and ignoring everything else that went on beforehand. And if I can just get this through your minds and get you to see this, your trading would be substantially better. I can almost guarantee it. Well, I can't guarantee anything, but in that regard. But that's what I'm trying to say, is that's the important thing here. Don't look at tests, and we're going to talk about tests later on in a little while. Don't look at them as signals. Don't look at them as candlesticks. Do you guys understand what I'm trying to say to you? Let's just stop here for a second. I want to stop and pause. Do you understand what I'm trying to say here? Could we see it as kind of a neutral period in the market? No, I don't see it as a neutral period. We're going up. We're going up and making progress going up, and suddenly we have volume coming in, lack of progress going up, and we're closing all in the same area. The market's either going to go up or it's going to go down. And now the odds are tipping that we're going to see something different here. Yeah, one bar doesn't make a story. That's a good one, Walter. I like that. There's a saying called one swan or one swallow. The swallows return to Capistrano, right? Every season. I'm not even sure where Capistrano is. It's probably somewhere near Italy or in Italy. But when the swallows come back, then we know summer is nearby, right? Okay. But one swallow, one bird flying along, does not make summer, does not make Capistrano, right? One bar doesn't do it. One bar does not make a market. One bar does not give us the structure. It's the current bar in connection with everything else that's going on in the market that will tell us about what to anticipate next. But at this point, we're looking for, we're seeing weakness coming in, and we're looking for either that weakness to evaporate with with buying coming in strong, or that weakness to manifest. Okay. Yeah, the action is in the background. I said this, Eric says, I like what you said in the last class, that the action is in the background or context, not in the last bar. Exactly. That's exactly right. I'm trying to give you different ways to think about it because it's so important. It's so important. Yeah, one tree doesn't make a forest. There's another good way to think about it. But you've got to combine this, that's why we say make a story. That's David's way of trying to get his traders to understand. What's the Wyckoff story here? The Wyckoff story here is a market that's been moving up that suddenly, that's having some trouble moving up now suddenly, or over these last three bars. We see weakness coming in, or we see lack of demand, weakness, and then just it's stalling here. So let's look at bar number 6. How do we describe bar number 6? Okay, well, we can all overanalyze. And what I'm trying to do is, it's not a question of overanalyzing, it's more a question of where the focus is. And your focus can't be just on that one bar. Widespread, right? Closing on its lows. Dramatic increase in volume. We got the biggest volume going on here on the whole chart. Okay? And now we can anticipate follow through with more sellers. I would sell this thing right here. Okay? I would sell this right here. Why? Because we had potential supply on bar 4 with the increase in volume, and now we have definite supply coming in on bar 6. Here we see the two biggest volumes on this chart, and they're both indicating supply. Okay? Also, we rally up above 4, can't hold it. Buyers bring this market up above the level of 4, and they can't hold it. And then it comes down, and it comes down big, and it wipes out all the buying on bar 5, on bar 4, and bar 3. And brings us all the way back almost to the beginning of this chart in terms of the close. That's supply. That's not going to go away. That's changed the market. Okay? Everybody see that? See how a story begins to help you understand what's going on? And if you're, instead of thinking about this is a test bar, don't think about that. Think about what is this thing doing? What is this bar telling us in relationship to everything else that's going on? And try to be logical about it. Okay, try to be logical about it. All right. So bar 6, we got supply. What's bar number 7? How do we describe that? And what's the significance here? I'll erase some of this so we can see. Narrow spread, right? It's almost the same as bar 5, it looks like. And it's an up bar. Good. I'm glad you caught that. A lot of people don't get that. They say, well, it's closing down on its lows, so it must be a down bar. No. It is an up bar, right? It's closing up above bar number 6. And it's on very light volume, okay? So they try to rally it up. They don't get very far, and it's on very light volume. It just means weakness, okay? And it's closing on its lows. They can't even hold the bar up. What about bar number 8? What happens there? Indecisiveness. No. It is a word, Walter, but it's not what I'm looking for. How do we describe this bar? And then we'll talk about what it means. Average spread. Good. It is about average, right? We've got narrow bars in here, a wide range bar, and then this, it's wider than bar number 7 for sure. But I don't want you to get confused by the variety of bars in here. If we go back a little bit more, and that's why sometimes we have to go back a little bit more, and it is basically an average spread bar, okay? And it is closing level with the bar before, same amount, right? And it's on low volume still. Slight increase, a very slight increase in volume, but it's basically low volume. So what does that say? Given the context of this market, it says that the buyers tried to bring it up above bar number 7 and failed, and it closed basically in the same area as the last few bars here. Okay. What about bar number 9? Let me do bar number 9 because I want to get in. I know we're going to run out of time, and I want to get into what we need to get into here. Bar number 9, we see a maybe slightly larger than average to average size bar. Let me erase this. Okay, an average spread maybe slightly larger, closing on its highs, and it is a slight up bar and a slight increase in volume, but still relatively low volume, okay, compared to everything else here. So what does this mean? Well, the market started to fall, and towards the end of the day, buyers did step back in and were able to bring it back up. But look at this. It's all these closes over 4 bars here, whatever time period this is, over 4 bars, and it is unable to rally up higher. And that's the story here. That here we had good movement going up. We see some weakness come in. We see sellers take control. And now there's really no ability for buyers to rally this market. Now, you might say, well, look, it dipped underneath the low of 8 and rallied back up. That's pretty strong, isn't it? I would say probably not. If they were really strong, why didn't they bring it up and close it above bar number 8? Why is it still in the same area here? And why did it slip down so far? If they, dipped it down to say this level here and then rallied it back up and closed it here, right? And we did that on a big pickup in volume, then I'd have to say, oh, buyers are coming back in. We're going to at least see a testing of the top here. But I don't see that here. What I see is more weakness, even though it closes on the high. And this bar is in here for a purpose. And that purpose is to make you think about what you're seeing. Because yes, it looks bullish because it's closing strong. It's closing firm. But in context, this is weakness. It's still weak. Okay? And you need to see that. Would I short after bar 9, and if so, why? I'd consider it. I'd be shorting on bar 10 as it's going down for sure. Okay? Let's look at bar 10. Bar 10, again, is widespread down bar, closing on the lows, increased volume. It's supply overcoming demand. And we can expect further downside movement from this. All right? So that's an introduction on how to read price bars using this little idea of the spread, the direction, the close, and the volume. And just looking, is it average? Is it above average? Is it below average? Is it increasing or decreasing? Are we in the middle, on the highs, on the lows? Are we up? Are we down? Or are we more or less level? Okay? And you can see a lot if you start to look at these bars, not just individually one after another, but in context with one another. You can really begin to see a lot. And let's take a look at a market. Let's take a look at a market here. Tell me about bar number A. What do you see here? How do you describe it, and what does it mean? This is, by the way, I use this chart a lot because I like it. It's IWM, which is the ETF for the Russell 2000. I forget what year. Anybody have a sense of what's happening on this bar? How do you describe this bar? So it's a widespread down bar, closing at its lows on above average volume, right? And that's exactly right. In fact, this volume here, except for the bar before it, is the largest volume on the chart. Okay, this is a daily chart. So what does this mean? It's breaking down through supports and it's closing on its lows. Are there buyers in here, or is it sellers that are in control? Who's in control here? It's weakness, right? Yeah, sellers are in control. You'd have to say that. Sellers are in control here. Supply is overcoming demand on this bar. What happens on bar B? And by the way, we've been coming in, we're in a downtrend. That should be obvious to everybody, right? We're making lower lows, lower high, lower low, lower high, etc. Okay? So describe bar B to me and what's happening here. Greater volume, right? Average spread, closing on the lows, climactic selling. Try not, okay, and I see that there's also people saying sellers are not able to drive the price down further, and so on and so forth. I would suggest that you just stick to trying to describe the bar for the time being, and then think a little bit, not so much in terms of its climactic or try not to label it, but try to understand what's happening inside that bar by this little song sheet that we're using here, okay, and comparing it to the recent price action and the recent market action and putting it into context. All right? So if we look at this, we have maybe an average to slightly above average spread bar. It's a down bar. It's closing near its lows, but it's closing off its lows. And it's doing so on the highest volume on the chart so far. And the spread is narrowed down compared to the spread on A, right? And yet, we have substantially more volume on B than we did at A. What might that mean? What might that mean? If the spread is narrowed down a bit on substantially more volume, buyers entering the market. Yes, buyers are entering the market. That's right. Because if it were all selling, think about it for a second. If it were all selling, we should see, on this kind of volume, we should see this bar be more like this, and not closing here, but closing like this. If that were predominantly selling there, okay, we should see, in fact, wider spread than A, so even more than that, probably more like this, and then closing down here on the lows, or close to the lows. And we're not seeing that, are we? And so only one thing can do that, and of course that's going to be buyers stepping in. And we know it now because the volume's high, because the spread has narrowed down a little bit compared to bar A, and also because it's closing off the bottom. Buyers are stepping in a little bit. And if we were to do a trend line here, what do we see? We see we're oversold in the trend channel, right? If we have a trend channel. And I'm not sure how we would draw that. Maybe that's incorrect. Maybe it's more like this. But even still, we're at the bottom end of the trend channel. That you should be able to see pretty easily. Even just eyeballing it without having to draw the trend line in, you should be able to eyeball it, okay? So buyers are coming in. What do we see on bar C? Let's talk about that. What happens there? What happens on bar C? How do we describe it? What does it mean? Average size up bar, closing on the highs, and the volume is high still, right? Exactly. Good one, Walter. Very good. Look at, we said that bar A was really high. Look at the volume on bar C. It's bigger than bar A, right? Kevin says up bar, closing near the highs with average spread and above average volume. Good. Good, Kevin. Good. Yeah, and by the way, this is the this software here has this blue line in the middle is the average volume for the last, I don't know, 20 bars or so, give or take. And so you can You can do that with if you got the ability on your charting package, but you should also be able just to see it. You don't have to necessarily have this is some sort of standard deviation function, kind of like a Bollinger Band on the volume. You don't really need to have that to be able to see this, but you can put it on if you want. But in any event, if we look at bar C, it's almost the same amount of volume that produced this. What is going on here? Well, think about it. We have a little gap open, right? We have a little gap open, so there was some urgent buying going on. Maybe they brought it up overnight in the futures market, and there's some urgent buying going on here. So they're buying above yesterday's close, and they're willing to buy, and they drive it up above the high of B, and they close it up above the close of A. Okay? And they do so on good volume. So is that buyers coming in or is that sellers coming in? It's got to be buyers, right? They're making an effort here. There's an effort to bring this, to stop this market down here and to bring it up, right? And they're doing a pretty good job of it so far. And there's still selling going on. It's not 100% buyers. You know, if this were all buying, then we would see a bar kind of like this, right? Similar to bar A in terms of spread, give or take, right? But we don't see that. And that's because there still is a lot of selling going on. But buyers are trying to overcome that here, all right? Yeah, buyers are coming in with a still high amount of selling, and they're trying to overcome it. All right, tell me what happens on bar D. This is interesting, isn't it? This is very interesting. What's happening? How do we describe this and what's happening here? Closing on its highs with an increase in volume after testing the lows of B. Yeah, good, Kevin. So and this is a widespread bar, right? We're seeing a widespread bar, not just an average spread bar. C was average, B was above average, but D is a widespread bar. Big volume again. I know it's not as big as A, but still big volume in here, closing on its highs. Now, think about this. What happened on this bar? We don't use the open because it's really not useful. Doesn't really add much information. But what we can say on this is that sellers probably came in the morning and tried to push the market down. And they got it down to the lows of B, or close to the low of B, right? But buyers stepped in force, and they turned the market around and rallied it all the way back up and closed it for the third day up, right? Or closed it above the previous 2 days and deep into the bar of A. And they did so on big volume. So still a lot of selling going on, but buyers overcame that selling. Okay, everybody see that? Okay, buying overwhelmed the selling. That's right, Walter. Looks like price has been driven down fast and then pushed up with strong buying. Yes, Lars, exactly. That's it. Okay. So now we've got a process going on here where, you know, if we look at these bars here, for example, 1, 2, 3. That's 1, 2, 3 volume, right? We see progress coming down, closing on the lows. Volume is increasing to the downside. We get a little relief in here. We try to rally up, but look at what happens to volume. It dries up. It goes down. Okay. Now look at what we're seeing here, just on these 3 bars. We're seeing the biggest volume on this chart, and we're trying to push up, and we're closing firm. Much different than this, right? Much different than this, if we look at it. Okay? This is the way to look at a market, at a chart. Okay, what happens on bar E? And what does it mean, do you think? How do we describe E, and what does it suggest? Average spread, down bar, close at the low, and still the volume is pretty high, right? Average range, down bar, closing on the lows with somewhat decreased volume, and I would agree with that, but still pretty high. And it tested the highs of the prior bar and lows, still not half, but halfway of prior bar. Okay, try, Kevin, not to be labeling things here. Just see what's there. Just try to see what's there. Average size down bar, closing on the low on average volume. And it's still pretty high volume, I think. You know, average volume is down in here. That's probably average volume. And if we extended this, and I'm going to show you a trick in a little bit here about volume, but if we extended this, it's still pretty good volume. Okay? All right. And Laura says supply coming in at resistance. Again, try not to label. Try to see what's happening in the bar and think about it in a logical way. Here, we do have a average to, I would say, slightly below average, somewhat below average spread, down bar, closing on the lows, volume is increased, and it's still high volume. And on this bar, buyers tried to rally the market up, but really couldn't do it that much. They only got a little bit higher than the previous bar. And then sellers came in. But on all this volume, sellers did not take the market down very far, did they? It's hard to know, and I'll be honest, you know, you got to be, it's hard to know exactly, if we were looking at this and there was no other bars on the chart, it would be hard to know exactly what's going on. Except that we know that there was a large amount of effort here. And probably buyers just got exhausted up here. They just, you know, don't have any more ability to keep chasing price up. They're running, you know, they're running out of money, if you will, at this price level. And yet, as it comes down, it's kind of like bar number C here, right? As we rally up, we have this, here we gap up, so it's a little bit wider of a bar, but as we rally up, there's a lot of volume, and buyers are pretty strong because they're driving that market up. Here, sellers are trying to push the market down, but buyers are not letting them come in too much, are they? Really, if you think about it. They're not allowing a large, here we have, in a down move, we have good ease of movement coming down here and on these bars, and here we have volume that's pretty close to A again on bar E, right? And we're not making that kind of downside progress. So even though buyers couldn't extend their activity up above bar D by very much, and it looks negative, it's not really, because sellers aren't taking the market down. Buyers are holding it back, if you will. Okay? If we drew a trend line, price would be respecting that. Yeah, you're right. If we drew a trend line in here, we would see that that would be, you know, a spot where the trend would be, comparing it with A, I see it becomes clear. And that's what, part of this exercise is to get you to compare what's happened in the recent past on the volume and the spread with what's happening currently. Okay. The bar between E and F is similar to E, right? Buyers don't have the ability really to buy up in here, and it comes back down, and it does come down a little bit more, but still on sustained volume, and we're not seeing ease of movement coming down. What happens on bar F, and what's significant about this? How do we describe bar F, and what do we see on there? Average size bar, closing near the high on average volume, right. Anybody else? What's the significance of this bar? It's pushed up again on the same volume as the previous bars. Good, good. We're seeing the same volume there, and we're seeing that the market is reluctant to go down. On each of these bars here, the market is reluctant to go lower. Average spread down bar, average volume making lower highs and lower lows, testing the low price of B. Yeah, and that's the key thing. Here's the way I view this. And we talk a little bit about Wyckoff in here now. Notice that we could draw a trend line underneath B and D, right? And so F comes down, dips underneath the lows of D and B, rallies up and closes firm. And the volume is pretty good, right? Only one thing does that, and that kind of completes really the buying that we see that has been going on since B. And it's saying that there's no more selling left in this market, that there really is no more selling left here, and that this would be a spot. Wyckoff, if he were doing his hand charts at night and saw this, he would put an order in to buy on the open the next morning. This would immediately pique his interest. And this is what we call a spring. We'll talk a little bit more about this later in this session, or if we don't get to it today, next session. But a spring means that we dip underneath an important support level, and B is important because that's where we first see buying coming in, right? And lower prices get rejected. There's no ability to follow through, and it closes firm here. And this is a daily chart, so if you saw this at night and you were tracking this market, then you'd have an order in the next morning. You'd either be buying this on the close or near the close, or you'd buy it on the open the next morning. Okay? All right. Now, what happens at G? What do you see here? The next bar we push up, right? But what happens on G? And we're long now. We're long from this area in here somewhere. What happens on G? And how does that make you feel? Wide range bar closing on the low, down on average volume, right? Slight pickup from the last couple of bars, right? Still some pretty good volume, and it would make you nervous. Now let's see, Kevin says, testing the highs of the previous several bars. Yeah, it came up to these highs, right, at E, and then came back down again, and came down on fairly good volume. Now, and Lars says that this would make him nervous, and it would make you nervous. It would, it would make it would make your gut churn a little bit. Well, let's talk a little bit about this now. This is where context begins to come into play. All right. We see from F to B here, or A, in this area. If I do this, you see a large, let me erase this and do it properly, sorry. If I do this, like this, and we compare it to all of this over here, you can see that in this area here, the volume has swollen. Wyckoff talked about this. He said that when we have been in a trend for a while, and then suddenly the volume swells and the market stops going down, then we can look for a change in trend. And that's exactly what's happening here. Okay, and we know that because we can see that on the chart. But if we were watching this day by day and we're up to bar G now, we say, oh God, it's making me nervous, I better make me feel like I've got to throw it out and throw it over and so on and so forth. Again, this is looking at one bar and saying that this one swan here doesn't make the summer, right? We'll make this guy a cute little swan. Doesn't make a summer, okay? We're long here from this point. We have a downtrend that stalls in here. We dipped underneath. There were no further downside prices. Also, if we extended this trend line here, didn't we break the trend line? Didn't we break the supply line? Assuming that we drew it like this, at least the immediate supply line here has been broken. And it has not come all the way down to where we would expect it to, all the way down to the bottom of the demand line. And we have this swelling of volume. And we have this swelling of volume where price has been stabilized. So just like when we said earlier on the earlier chart, one bar doesn't doesn't change things. It's the same thing here. Even though it looks negative, this is just most likely just the professional traders, the larger traders, doing one last shakeout here to come back into this area. And let's look at this a little more carefully. To come back into this area here where there was very high volume, and we don't have that big pickup in volume anymore. Okay? What happens now on bar H? Describe this to me. What's happening here and what's the significance? Walter asks, does bottom building require high volume? Bottom building typically, unless you see a long saucer bottom type thing, bottoms typically do require high volume to stop the market from going down, and then it's a process where we come down and test, and there typically is high volume. That's right. Okay, so we have narrow range up bar closing in the middle on low volume. Narrow spread up bar, average volume closing in the middle. Exactly, right. Narrow spread, it's an up bar because it's closing just slightly above the close on G. Light volume, what's the significance of this bar? This is the most important bar, or one of the most important bars on this chart. What's the significance? No more sellers. How do we know that, Walter? How do we know there are absolutely no more sellers at this point? No follow through to the downside after G. Exactly. Everybody get that? Very good, Hans. Here we're all nervous about G, thinking that there's sellers coming in. If there were, they would take it down. They've got the advantage here, right? They would bring this market down and drop us underneath F. But it doesn't happen. Instead, what happens is we come into almost like a little apex here, right? And this is what Wyckoff called being on the springboard. We are on the springboard for prices to rally. And he said that there comes points in every market that he called critical points where a feather's weight would seem to tip the scales one way or the other. And if the trader can identify those areas. They've got much to win and little to lose. And if we look at this area in here, right, represented by this springboard position here, we can see that we went through 1, 2, 3, 4, 5, 6, 7, 8, 9 bars here. Not, every time prior to this, we didn't go through all of that. We dipped underneath and we rejected prices. We have the swelling of volume coming in at the end of a trend. We've broken the downtrend channel. We can clearly see through the price bar actions in the background that buyers made a huge effort to come in. We can clearly see that sellers made an effort too, but buyers kept the market from going lower. And sellers got exhausted down here at F. And now we're at the point where we're back in the middle. It's almost like an axis line, although there's no axis line to be thought of here or to be seen, but it's almost the same idea. We're right here in the middle, and we had one last little gut check, so to speak, and then no follow through. This is the springboard, and then the market goes up from here. Okay? And the last thing I want to just note here are these last two bars here at I and J, and I guess I didn't label J in here. That's here. Notice that the market starts to float up on light volume. That happens all the time, and don't make the mistake of saying, oh, narrow spreads, light volume, really kind of decreasing volume on the rally, that must be weakness. Absolutely not. It's not weakness because of all of this that happened here. And this is just, there's no sellers left. That's what this means. And buyers are, because of all the downtrend that's been going on and all this Sturm and Drang in here, there's no outside buyers coming in either until we start rallying up here to K and on and on. All right. Very good. Any questions on this chart? And how does this seem to you? Is this useful to be able to look at a chart like this and begin to understand it? What's really going on behind it? This takes a lot of practice, by the way. It took me years, I think, to develop this. And you have to go through and, the markets you're trading, start charting them out. And I would suggest doing it both on the daily and on an hourly basis too, and start looking at the volume and the spreads and the closes and the direction. Yeah, Walter says it takes discipline. Absolutely, it takes discipline. But start doing that, and doing it on the hourly, you get 6, 7 bars for every day, and you begin to get good at this stuff. You really do. Just describe each bar. All right, let's see what time it is here for a second. We started at 3, and it's now, we're an hour and a half into this. Okay. And we're on slide 22, and I've got how many slides here? 60 to go. Okay. So what we're going to do, I think we're 1/3 of the way through. I'm not going to be able to finish everything tonight. But I think what we'll do, therefore, is we'll go for another half hour, because it is Saturday. And we'll go through maybe the first 2 of the strength signs, and then we'll stop, and then we'll pick it up again on Wednesday night and finish that up, and then we'll start weakness probably on Wednesday, and then we'll play a little bit of catch up. I've been kind of moving things around in this course a little bit, and trying to make it more intelligible, I think. In other words, so that you really understand it, and you really can. It's not a try to make it as less a mystery as possible. And although I'm doing that, I think I'm doing it successfully. Although I'm taking the mystery out of it, it is a skill that needs to be developed. You can listen to me, you can review this later, and you can. I'll send out some material as we go along, and you can read the material. it's not going to make you able to do this just by doing that. You have got to practice it. You have to practice it. There's no other way around it. We're human beings, and our brains are built to learn through repetition. And that's how you have to do it. And it's hard stuff. It does take discipline, absolutely. All right, so let's go on. This is a quote from Wyckoff. Comes out of Studies in Tape Reading that was written in 1910, and I would encourage everybody to get this book and read through it. I've read it numerous times and continue to reread it because I think it's so valuable. And it's his pen name, his pseudonym, was Rollo Tape, but it is Richard Wyckoff, and it's one of the first books that he wrote. And in this book, he talks about the swelling of volume in this book too, by the way. It's very, very useful. And other things that he talks about. But in this book, he says this quote, and I think this is just a great quote. The study of responses is one of the most valuable in the tape reader's education. Today we don't read the tape because it's too active. There's way too much volume. So but we can substitute chart reader's education. Okay, so the study of responses is one of the most valuable in the chart reader's education. It is an almost unerring guide to the technical position of the market. And that's what we're talking about here. That's all we're talking about here. Okay? All right, so one of the patterns that comes up frequently is this thing that we call a two-bar bottom reversal. Two-bar bottom reversal. It's a two-bar pattern. And the first bar is a down bar with the low and the close down below the previous 3 or 4 or 5 bars. And it's just an area, okay, below the previous bars. Then the next bar in this pattern is an up bar. And it's best when it can dip below that first bar, rallies up on widespread, and closes above the high of that first bar. So in other words, we have some sort of a down move. We have bar number 1 closing pretty much on its lows. Bar number 2 dips underneath of it and closes back up like this. Very strong pattern in the right location. And we're going to most likely see high volume. Okay, and that's that swelling of volume that occurs at the end of a trend. So let's take a look at this. Here we've got a chart where on bar number 1 we've been in a move down, but you can see that bar number 1 is closing down below the low of all these bars, in fact, all below the low of every one of these bars on the chart. And then bar number 2 comes down below that, dips below it, dips below this bar here, and then rallies up and gives some strength. Now, if we look at this, and we look at this carefully, we could do the same kind of bar-by-bar analysis that we were doing before. We can say on this bar here, it's a widespread bar, it gapped down lower. This is I don't forget what, this is some sort of an intraday chart, I forget what it is. But it has a gap down in the middle of the day, it looks like, and widespread on big volume and closes near the high. So buyers came in here. And then we can see that sellers are not really all that active down in here. And they try to drive it down on bar number 1. We see the pickup in volume a bit. And yet they bring it down underneath, and buyers come in strong here. And they do so on good volume. Okay? So what do we expect? We expect prices to go up and rally from there. Okay? And that's exactly what happens. And we can also, put in a chart, a trend line, and show that we're oversold down here. So the pattern is there, okay? But the pattern can be anywhere. And so, for example, This is what I would call a look-alike. It's almost the same. Here we have a down bar. Bar number 1 is a down bar. It's down below the previous bunch of bars. Bar number 2 almost ticks underneath, not quite maybe, but closes firm, right? Is this one that we want to go in and buy on and you know, maybe if we're trading on the intraday, maybe we'll take a half a point or so out of this. And it does rally up, but there's no background here. Here we get a much better move out of it. And then it comes back down and tests down in here and then starts to rally off again. But this is much better than this because of, not because this dips underneath and rallies more firm. That's not the reason. It's because the context is telling us that buyers came in, it's oversold. Now buyers are really coming in, and sellers are no longer able to drive this market down. Okay? What about bar 3? It could look like profit taking. Yeah, it could. And you don't know, you know. You really don't know if selling is going to come back in or not. You would have a stop below here, and you have placed your bet on this if you took this, and that's what it is. It's, you know, that's where you are. And if it fails, it fails. Most of the time it won't if you're reading the market correctly. But it's also a pipe dream to be thinking that everything that you do is going to be 100%. It's just not possible. You know, it was funny. I was talking to somebody today. It was over tennis, and they were talking about how baseball players are, you know, a great batter is hitting, you know, 300, 350 in that range. That's, you know, 3 out of 10 times they're getting a hit, and 7 out of 10 times, twice as often, they're striking out, they're flying out, or they're getting out, right? They're failing twice as often as they're winning, and yet they're considered to be great players at that level. And that's, you have to adopt that attitude that, you know, things don't always work out. This is a game of probabilities. And in a game of probabilities, and we'll talk more about this, but in a game of probabilities like trading, there's a probability that you, like, let's say your trade setup has a 75% win rate, okay? Meaning that 75% of the time it's going to win, and 25% of the time it's going to fail, okay, or it's going to lose. So that equals 100%, obviously, right? So if that's our trade setup, then the way we want to think about this is that, say over, I don't know, 500 trades that we make on this, 75% of them, or 375 trades, are going to be winners, and 125 trades are going to be losers. And let's say that we are making, we'll just make it easy, 3 points every time we win, and when we lose, well, let's say we're losing 1 point. So we have a good win, you know, it's a good expectancy here as well. So if that's the case, then we're going to be, and we're just using American dollars here, then we're going to win 1,025 on our wins. Is that right? About that? And we're going to lose 125. And so net on this trade, our expectancy is that we're going to win $900, right? Or 90,000 if we're trading whatever size we're trading, right? So that's our expectancy here on a or a partial. It's not quite. You got to do some more calculation, but that's the idea here. Okay, so that's how you have to think. You have to think in terms of 500 trades, and 375 are going to be winners, and 125 are going to be losers. So there's a paradox here, and the paradox goes like this. over a large number of trades, if I have an edge, then I'll be profitable. So over a large number of trades, like 500, if I've got an edge where this is winning 3 points, three out of 10 times, 75% of the time, it's winning 3 points, then I'm going to be profitable. I'm going to make $900, right? But there's always going to be 25% of the time where it loses. And I never know on any given trade whether this one is going to be in the win column, it's going to be one of the 75%, or this one is going to be one of the 25%. Okay? You follow what I'm saying here? We never know on any given trade whether it's going to be a winner or a loser. But over a large number of trades, if we have that edge, we'll be profitable. Okay? So if we go back here and we look at bar number 3, we have a perfectly valid setup here, and the context is good. And we take this trade, but bar number 3 comes in and we scratch out of it, or we get out of it because we get because we get scared. Then what we're doing is we're focusing on the wrong side of the paradox. We're not focusing on the large number of trades, the 500 trades that this one is a part of. This is one of 500. What we're focusing on is the thing that we never know, that any given trade can be a winner or a loser. And we're trying to make this is the bane of every trader. This is where every trader falls apart. They focus on the wrong thing. They're focusing on whether this trade is going to be a winner or a loser, and there's no way to know. Yes, we improve our win-loss ratio, our 75 to 25 ratio. We improve that. Maybe we can get it up to 85% and 15%. That's not unheard of if we focus in on context, right, and the background, and we develop a story about the trade. But still, we're going to have some number that fail, even with a good story. Even with a good story, some number are going to fail because it's a probabilistic game. If you're focused on whether this is going to win, this one trade is going to win or lose, you are going to be a loser overall because you're going to be focused on the wrong thing. You're putting yourself on the scary side of the paradox. You're going to scare yourself out of good trades, and you're not going to, you're going to damage this. You're going to confound this edge that you have, this winning edge. Okay? So I've gone off on a tangent. I don't really mean to do that, but that's important to understand here. When you're looking at this, when you're looking at the game of trading, if you're focused on, think about it like this. Think about it like this. A batter in the American League, baseball league, is not paid on his first or his second at bat, right? His first time up at bat. He's paid for his season. Last season he had a 325. So he gets, however many millions of dollars for next year because he has a proven track record, right? Think about it like this. A casino, a gambling casino, where their edge is not 85-15, it's 5%. They're losing 95% of the time, or 90% of the time, and they're picking up 5%. They're not focused on every blackjack hand that's played or every spin of the roulette wheel. They're not focused on that at all. They're focused on this. They're focused on this. You have got to get your mind around this concept of probability. Understand the paradox that over a large number of trades, if you have an edge, you will be profitable. But any given trade, we never know whether it will be in the win column or the loss column. You have got to get your mind around that and focus on this and not on the individual trade. Because if you're focused on the individual trade, I guarantee you, you won't be trading in a year or two. It's as simple as that. All right, I've been on a soapbox here. Sorry about that. But that is the truth of trading right there. That is the truth of trading. All right, so let's go on here. And you tell me about structure. Here is another example of a bottom reversal. We're coming down, 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 down. This bar is lower than the previous bunch of bars. We dip underneath. We rally up. Volume is pretty good here. Volume comes in on the rally. You can see that. We close firm. Why is this a good trade? What makes this a good trade? What makes this a good trade? Think structure. Buyers are coming in with the bottom on the close on the highs. That's right, Kevin. And that's the setup here. That's the signal of strength here, the sign of strength. But why are we getting this here? Why is it coming in here? We don't see it anywhere else here. Why here? Why is this coming in here? Why are buyers so aggressive in here? Higher than the previous low on the left. You mean over here, Lars? That's right. We can draw a support line in, right? We can draw a support line. Why else? That's a key thing. Markets come down, tested this support, can't get any selling going. Buyers see that and act aggressively. And there's our signal to go long. But why else? Why else? I'll just give another moment or two, and then I'll show you. It's all about structure. Yes, the channel's oversold. Excellent, Herbert. Excellent. We can draw a trend channel in here, and it's not exact or perfect, but you can see that we are oversold. So we have a confluence event in here. Remember that from last week? Or the week before? We're oversold in the downtrend channel at a level of support, and we get a 2-bar bottom reversal with increased volume on the buying. There's a nice story. That's a good one to take. That's a good trade to take. That's why this works so well. And look at how it moves. Okay? Let's go on. Here's another one. First bar, bar A here, down below pretty much all these bars. Second bar dips underneath, comes back up, closes firm. Why is this such a good one? It's the same thing, right? Everybody see that, I hope? That it's the same thing here? Yeah, okay, good. I can draw the trend line in. Here we're just testing. We're not going underneath here, but we've got support, and it should be support again. And if we drew the trend channel in, it's pretty much the same game here. Pretty much the same game. So this tells us that here's a good spot to go in, right? Here's a good spot to go in because we know that what's happening is there's this last little flush, so to speak, on the first bar, and the second bar shows that there's no further selling and buying comes in aggressively. Okay? It's different than here. Here, clearly, we get an increase in volume and buyers step in a little bit and then the next bar is up, but that's not as strong as this, and you can see that. But people will look at this and say, oh, you know, we're oversold in the trend channel, let's go long here, and so on and so forth. Don't do things like that. You know, wait for where you can really build a story, and then you get this kind of a setup, and then you got something going for you. Okay? Yeah, it's a minor spring, that's right. Now, bottom reversals, 2-bar bottom reversals, don't only have to happen at the at the bottom of a downtrend. We can be in an uptrend. You can see here we're in an uptrend, and we have the first bar here is down closing. This one may be a level close, but it's good enough. I would call it a look-alike. If it looks pretty close, then it probably is, right? So we get that move down, we get dip underneath, and then it rallies up, and then we go higher from there. And we get a nice move off of this. And this is in the Canadian dollar futures. By the way, this is a weekly chart, by the way. When you look at the charts in this, what I try to do is, I focus mostly on the S&Ps because that's what I trade day in and day out, and I do it off of a tick chart and a 5-minute chart and stuff, and certainly there's going to be a lot of those charts in here, but I also try to show you examples of widely divergent time frames and different markets, so that you can see that indeed this works all the time in all markets across all time frames. Okay, why is this not a bottom reversal and this one is? Why is this not a bottom reversal and this one is? That's okay about the caps, don't worry about it. Why is this not a bottom reversal? And this is important in this little setup. Okay, I'm not seeing any responses, so I'm assuming, and you just learned it tonight, so that's okay. Not in an oversold position. That's right. It's not oversold. Look, the bar before, it's not that this is not strong. This looks strong to me, where the bar dips underneath and rallies up, and then this one dipped down and rallied up. I'd be buying that, no question. It didn't give us great response, but it was pretty good. I would have been feeling pretty comfortable about that. Okay, but it's not a bottom reversal because we don't get that little flush. Here we get a flush down. In other words, they're taking out that flush starts up here really, and they're trying to shake out the weak longs, if you will, and then once they feel that the weak longs have been shaken out, then they will rally it up like this. And that's the main reason. We need to see the market coming down and have that little flush, whether it gets oversold or even just oversold in this kind of small trend channel in an uptrend. Okay? That's important. We always need to see that. Now here's an interesting one. This is a 5-minute chart, intraday chart. Ignore this stuff up here. Here we have the bottom reversal. We've got the first bar coming down lower than anything else here, lower than the last 3 or 4 or 5 bars, right? And we dip underneath and we rally back up and close up. This is technically a bona fide bottom reversal. But and there's a story here that can be crafted. We're certainly oversold in the trend channel. There's no question about that. Okay, and we see this widespread bar coming down, and it closes off the lows on very high volume. The next bar, which is the first bar of the 2-bar bottom reversal pattern, doesn't go down much further, and the volume compared to back in here is pretty good still. And then we dip down and we reverse back up, and that's good. And this could be bought. This could be bought. It's a little, you're in a climactic kind of situation here. We're going to talk about climaxes too. You're in a climactic situation here. And typically, what will happen in a climax, despite the fact that this is a bona fide 2-bar bottom reversal, what will happen in a climax is typically we come back down and test this level, which is what we did here. Okay? We can't now. This is market knowledge that you may or may not have. So you might buy this, but we're not getting much of a movement up here, and it stalls up in here, right? Notice how we get that small bar here with the light volume. Just no ability to rally up here beyond that point. and then the next bar comes in, it's a pickup in volume, and it wipes out the buying that occurred on the previous few bars. So if you did buy that, you're scratched out here. And by the way, there is no shame in scratching. I scratch lots and lots and lots of trades. I'll get into something a little early, maybe something like this, right? I'll get into this a little bit early, and then this will happen to me, and I'll scratch out, and maybe I lost a quarter or a half a point, or I broke even, or I made a quarter of a point. I consider all of those scratches, okay? And I wait for a better opportunity. And when we're down here where the volume is substantially less and the spreads are narrowed now, right? Not much movement. A lot of movement over here, a lot of Sturm and Drang, a lot of activity in here. Now it's pretty sedate. There's no selling going on in here, right? So now as this thing moves up above this trend line, maybe I'm buying in here, and now I get the ease of movement that I was looking for back here but didn't get. And now I feel like I'm in a trade, okay? So that's okay to do too. So sometimes the bottom reversal doesn't have to mean that it is a buy trigger every time, but it is a sign of strength in its own right. And we can put together a story of being oversold in the trend channel down here, some climactic action, which I'm going to teach you, and a bottom reversal, buyers coming in, and then, you know, we wait for that test to occur, because I don't see support over here. Where is that? There's no real support here. So you may decide to buy this, but when you see something like this, then you know you want to tighten your stops, and you see something like this. In other words, you see this kind of anemic rally. You want to tighten your stops, and then you see, and you want to be aware and be on guard for something like this, and that's when you scratch out, right? And that's how you keep your expectancy high, because your losses are going to be small. They're going to be mostly scratches. And that's one of the ways you keep expectancy high, your trade expectancy. And then we look to take a trade down in here, and that's when we look for this, okay? So just a piece there. All right, let's do selling. Any questions about bottom reversals? So when we can concoct a good story about it, when we can craft a good story of support and being oversold and buying coming in and so on and so forth, they're very good trades. When the story is only, you know, half a story and not a full story, then you want to be a little more cautious, and you want to wait for it to be tested. And we'll talk about tests probably next week. All right, we'll do selling climaxes, and then we'll call it a day, because I'm tired and we've covered a lot of ground, and we'll pick up next time and we'll get it all. Okay. So, selling climax occurs after a significant move down on whatever time frame we are trading on. Now, it's not just big widespread bars. You're going to see widespread down bars closing on the middle or the high. No question about it. It frequently is going to come on more than one bar. You're going to see multiple widespread bars, and you're going to see that volume expand dramatically. But you also, and this is the thing that's never taught, and this is important, you're going to see that trend accelerate to the downside with those wide spreads down. And I'll show you exactly what I mean. Here is a chart. I've traded this stock. I like this stock. This is a 60-minute chart of ConocoPhillips, good oil stock. And you have to take my word for it. We're in a downtrend, and the overall trend has been here on this blue line. And you can see that we start to accelerate here. I say you have to take my word for it because the data is off the chart here. But we start to accelerate here. And it's not clear that it's going to really accelerate, but it does break down through this demand line here, and it really starts to plummet. And this is what I mean by climactic action. This is what we want to see always in a climax. Okay, the market plummets and the volume starts to expand. We see the widespread bars closing in the middle, and here we have a bottom reversal. This is, I guess we saw this chart earlier. We have that bottom reversal. Then it comes back down here and gets tested on less volume, and that volume is this. You can see it's much less than over here. Okay, and we have, really, this is climax, and this is kind of climactic too, this bottom reversal. So this is the climactic volume, and we see that when we get over here and it gets tested, and we'll talk more about tests next time, that then it's more safe to go in and buy this. But this is a nice example of climax. We're getting the plummeting, that acceleration in the climactic action. Here's another one. I didn't draw in the trend lines here, but you can kind of see them. We've got a trend channel here. Then it starts to get steeper, right? Then it plummets and it accelerates. And look at the widespread bars here. The first one coming down, you get, as it breaks down here, it's widespread, increased volume, increased spread, closing on the lows, right? And then look at the next bar. You all know how to read this now. We get even bigger volume. It's the biggest volume on the chart. And that's often what we'll see on a climax, is the biggest volume on the chart. And then it closes here in the middle of this bar and almost above the low of the prior bar. Only one thing does that, that's buying. And when we see the trend accelerate like this and it starts to plummet at the end, then we know we've had climactic action. We've had a selling climax. And the odds are very, very good that the downtrend is over. Okay? But you have to have this acceleration. It often, and really I would say V-spike reversals, this will produce a V-spike reversal, meaning that the market comes down and then it just starts trending right back up. So that's a V-spike, okay? V-spike reversal. These happen about 10 to maybe 15% of the time. So they're not worth thinking about too much. When you recognize them, I mean, they create quite a vacuum on the other side, and they can be very good. But I don't try to trade those, because I never know when a V-spike reversal is going to be setting up. They always set up off of a climax. So if you are interested in being a 10% trader, and you would buy this here, Wyckoff would buy down here, but he'd be buying stocks against an index. It's a little bit different. I don't recommend that. You can if you want to, but I don't recommend it. You can buy the test. Here's a test, and here's more testing. And you can see that the market here dips underneath and rallies back up. We don't get a great rally, but here we come down. It's choppy coming down. We tested a couple more times. Now we get two tests. It's not going down anymore, and then the market accelerates. But it's all based on this selling climax. Okay, a couple of questions. Why wasn't it a climax at the end of 11.9 over here, 11.19? Why wasn't it a climax there? Because it just wasn't. It's just, there was not real buying coming in. There was not this heavy volume. There was an acceleration in the downtrend, that's true, but we don't see closes in the middle. We see all the widespread bars closing down below here. And that's why. We also get this nice little, lay the structure out. You can lay out this structure. It's just amazing when you look at it. You've got, this is your support, turns into resistance. Look at hugging the lows here. We talked about that. I guess it was in deep practice. We have a little ABC pattern. You can draw that in. We've got confluence here. We've got a resistance line here. There's no way that this is not going to be going down. Okay? Here, and we don't really break that downtrend. We got more than, confluence. Here, we're not keeping going down to the trend channel. buying is coming in, it's stepping in here. So, we confirm it, if you will, with the testing. The testing, in part, tells us that supply has dried up because structurally, in terms of the structure of the market, this is not coming all the way down to the demand line anymore. It comes down to this support level and tests, and then holds that testing. You can see here when it came down to this support level to test, it broke right through and just held the lows and started to accelerate down into the climax. All right, so that's the reason for that. Here's climactic action. Here we're coming down, we've got a downtrend, it increases, and then it plummets. This is an intraday chart, I think, a 5-minute chart. We see that all the time. Again, the high volume comes in. Here on this chart, for example, here's a moving average, and then here's Bollinger Bands just on the volume. 2 standard and 3 standard deviations. So you can do something like that if you want to. I wouldn't bother. It's better just to be able to see it as it is, but you can clearly see that this is the largest volume on the chart, and look at that close there. It's the same thing. Here we have to say sellers are in control. We have supply over demand. Here buyers are making a big effort. Because it has accelerated in a downtrend, and because we've got the biggest volume we've seen, we can say that it's likely to be climactic. It comes down here and tests, and we get a better test at D. This is a lovely test. Both E and D are nice tests. And then it rallies up from there. We'll talk about tests next time. One last example. Again, here's the Aussie dollar, I think on a 60-minute chart. We are in this trading range, slight downtrend. The trend gets accelerated and oversold. We get big volume. Look at the wide spread. Look at how that's closing way up here. And then at B it gets tested. And then it starts to rally up. Okay? And it gives a nice rally. Yep, I've got one more example of a selling climax. It's pretty straightforward now that you see it. Look at how often it comes up. This is a S&P 45-minute chart, just of the U.S. session. We fall down out of a trading range. We can draw a trend line. It accelerates. That acceleration is so important. The wide spreads come in. Biggest volume on the chart. Look at that close. Comes back down, gives a test, and then starts to rally, and it hits this level here. And the next day it does go up. You can see that the next day it had a bigger price. You mentioned that you have a trick on how to measure low, medium, and high volume. Well, I think I showed you that, where the volume swells. That was the idea. So you can even see it on this chart here. Right in here, you can see that swelling of volume. And you can compare that to everything else on the chart, and it's going to be, combined, it's much greater than anything else here. And that's what we look for. One of the things we look for. All right, next time we'll start with tests. Any questions then? Any other questions on selling climaxes? Yeah, we're almost 3 hours into this. 3 hours and 20 minutes. I apologize for that. Got to figure out how to do this where there's a little bit less. Okay, seeing no questions, I'm assuming not. If you do, send me an email. Keep working on structure. Keep working on waves. Don't forget those, okay? Keep working on structure. Keep working on waves. And I will see you on Wednesday night. Well, I'll send out the slides for the next set. We're going to be playing a little, not catch up per se. Don't worry. I'll take all the time we need. We'll cover everything in the same level of detail that I always do. Don't, even if I have to put an extra session on and make it 9 sessions, I will do that. Don't worry about it. Okay, we'll get through all this material in a full, complete, and comprehensive way, because I want you to understand it. That's my goal. It's always my goal, is that you all understand this as best as I know how to explain it. And I will not, I will not short that that objective. That's important to me personally, because I want to see you guys succeed. All right. Thanks, everybody, and I will see you next week. Yes, a lot to digest. That's right. So it's not such a bad thing to go a little bit slower in the beginning. All right, have a great weekend. I'll see you Wednesday night. Take care now. Bye-bye.